The first start is as flat can get. 3 points higher, 1 point higher on the Nifty, 1 to 2 points higher. So it's just where it was yesterday. A little bit of red, but nothing much, nothing concerning as of now. Okay, now it gets to 6 points lower. There is a big cut in the Nifty Bank, 0.4 down. So that's, doing some bit of the negativity. The one that's falling, of course, Bandh is falling. I don't think that's a big weight on the index anyway. There will be a lot of overhang on Bandh for sure. HDFCs as well as their own promoters. Yes Bank is pulling it down. And Axis also is giving up some of yesterday's gains. Axis was such a tall gainer yesterday. HDFC Bank is giving up 0.5%. So it's only the Nifty Bank that's showing that bit of a bother. But Sensex and Nifty are as flat can get. I think we should pull up Gruha as well, because that's the stock that's losing the most at this point in time, 9% down. So not as bad as the pre-market indicated. But yes, 8% had to go anyway. It's 9 down. Bandhan is 4 down. But HDFC, my sense is in the green. So let's come to the Nifty stocks now. Nifty at the moment still flat, 20 down, but I would still count that as flat, 10,750. 1% up on Tata Motors, Eicher Motors. All the automobile stocks got beaten down yesterday. Yeah. Today they're showing a little bit of recovery. So 1% higher on Tata Motors, Eicher. Infosys also up ahead of, I guess, the tech numbers that will come. DRL, Vedanta, IndusInd Bank, all of them in the green, but just by 0.33%, not much. Auto stocks have seen a little bit of covering, and the IT stocks are good. I think the rupees just weakened a bit, now costs about 70.10 to buy the dollar. On the red side is M&M, down 1%. I mean, there's a bit of an investigation over there. May not be very serious, but 1% down. HP, BP, all the oil refiner, oil sensitives are a bit down. Indiabulls Housing continues to move down. So the negativity from the yield side, yields going up to 7.51, 52 is hurting. Well, that's the story really. It's flat, but that's the divide.
Okay, on the mid-cap side, you've already mentioned GRU and Bandhan. Those stocks continue to react to the news points there. Look at the selling on Page Industries. I've got my eye on couple of these stocks. Ashok Leyland, Page Industries. It is relentless the way these stocks are being sold out early on, and such a big stock gets hit quickly. Bharat Forge, add another one. This trio has been just moving lower and lower. There's some more selling on DHFL. Watch out for the housing finance companies anyway, because yesterday DHFL got very wobbly around close. There's some more weakness coming in on that stock as well. In terms of news flow, Sadbhav Infra, 6% growth in toll revenues. Market likes that. So 6%, so about 3% up on that stock. Endurance has done a small acquisition, 2% up on that one. Prabhat Dairy has got into a Danish joint venture for some products. So again, that news flow is working well. 3% up on Prabhat Dairy. Dish TV, the stock we were just discussing with Prakash Diwan. Again, there's some incremental buying this morning that's coming through. So those are some of the initial mid-cap reactions that we are getting. Watch out for the real estate stocks that were so excited on hopes of this GST cut yesterday. A lot of that is getting undone as we're speaking. India Cements is a stock that I saw under pressure. NBCC, there's more buying. That is continuing as well.
Cements,
so very,
of course,
very
got a negative comment from CLSA, so there may be some selling because of that. But now the cut has gotten deeper across the board. It's 1/3% lower now for the mid-cap, almost 0.5% down for Nifty Bank, and Sensex and Nifty are down about 1/4%. Now is their direction, Ashwini? What is the Nifty trade?
Well, the issue is that basically all sectors are lower other than one or two sectors like pharma and probably, realty. The problem is that financials are coming under the hammer. For some reason, they've taken very poorly to whatever data has been announced. So that way, there is follow through from yesterday's selling. So my sense would be that you can get short, intraday on Bank Nifty, and chances are you'll get closer to say 27,050, 27,100. And on rallies, this market is now sell on rally. 10,800 is your stop. And basically because this was such a financial driven rally, chances are that Bank Nifty should outperform on the downside. Plus all of those, crude sensitives, they are giving back some of their gains. So NBFCs, financials, these crude sensitives, some of that trade is getting reversed.
Okay. Mitesh, I think Godrej Properties was your call. So, yeah, that stock's actually calling out tension because it's managing 2% up move even now. Anything else that's on your radar? First thoughts on the opening?
So, I think there's some software issue with my laptop. I think give me some time.
Technology.
All right, tech. We will be discussing that in some detail with the results round the corner. Ashwini, any 920 call? Specific stock?
See, India's cement is down about 3%, so chances are that this can have follow through. Plus, get short on all of these PSU banks because I think they have a lot to give up given the bond yield, etc. And overall, I think large stocks are coming off. So RIL, Infosys, basically there is a very negative sense of the market. So my sense is that you will face selling on all of these large caps which have held up the market so far.
Yeah, I take your point, Ashwini. Reliance, most of these stocks, of course, HDFC itself is down and out. But even TCS, from the opening highs, there's a little bit of a slippage that's coming in. All the OMCs are down as well. Sudarshan, just very quickly, your thoughts on the open and any stock idea you'd like to leave us with?
Well, the opening is disappointing. My suggestion, do nothing. Don't buy and don't sell or do nothing. Just whatever. If you have a position, stay with it and just forget about the indices for the day. I think Infosys is a buying opportunity. And so is TCS in spite of the early morning slight dip. Both IT stocks should do well today.
Okay. So you're not taking a positional call on the index as you suggested earlier. At the moment, no?
Yes, that's a positional call. If you have long positions, stay with it. There's no rush to go and add to them. Okay. Let the market stabilize.
All right. Okay, gentlemen, we'll leave it at that. And of course, come back to you for advice on the hour. Sudarshan, Mitesh and Ashwini, thank you very much for joining us through the pre-market. It's not a great cut. It's about a third of 1% lower. 10,740 thereabouts is where the Nifty is. The Bank Nifty is taking a little bit more of a nick, about 0.5% lower. With that backdrop, and as we stand to step into yet another earnings season, Nilesh Shah, Managing Director and CEO of Envision Capital, joins us as the market master. Good morning, Nilesh. Thank you very much for joining us. We would have much loved you to have come on the day of the results, TCS or Infosys, but we'll call you up on that day. How do the tech earnings look to you? Do you still think that'll be the island of performance?
Yes, it pretty much looks like. I think the earnings is going to be good from the tech biggies, especially the big players. Clearly, I think the growth momentum is still there. Volume growth should be good. Clearly, for the year gone by, and I think the outlook still on the technology side is still kind of very robust. They have a strong tailwind of the currency as well. So I think on the whole, I think they should be set for either high single digit or a low double digit kind of an earnings growth. But I think what is going to be very, very important is going to be the outlook that they present for 2019 in terms of how is the US looking, especially in the backdrop of some of the big tech guys out there giving some kind of, a downward revision in their guidance. I think that is going to be far more important. I mean, even seasonally, if you look at it, post the December quarter, really what the street is more interested in is knowing is how's the calendar year looking rather than how just 1 or 2 quarters are looking. And I think that's going to be very, very important.
Nilesh, good morning. Are auto stocks pricing in way too much pessimism? Is this a buying opportunity or is this a real slowdown threat?
No, it looks like that the slowdown threat is for real. Okay. I think, of course, the industry and I think most players have been talking about some kind of a liquidity squeeze and the NBFCs not having funding and therefore that's impacting demand. But I really don't think so. I clearly believe that there are banks out there who have enough liquidity to lend. I'm sure all the deserving people still receive 2, 3, 4 calls a day in terms of saying, take some loan, take some credit, take all of that. So I think in context of that, clearly I think there is a slowdown. That's the reality. And I think that's kind of in a way symptomatic of the kind of stress which is there in rural India, the kind of farm stress, etc. I think a lot of the demand in India, incremental demand over the years has been coming in from the rural sector. And that I think is really impacting the aggregate demand for automobiles. So clearly looks like that they could have maybe another quarter or two of a slowdown. Of course, in between, if there is any kind of a fiscal stimulus in terms of, say, for example, GST rates being cut on automobiles or two-wheelers or all of that, that could trigger some kind of buying demand. But otherwise, if that doesn't happen, then I think we'll have to be content with the kind of current performance of the auto guys.
Okay. Well, the cut looks tough because they're not even making enough money on direct taxes. Indirect taxes, they are down by a huge number. Maybe.
But this is the year of elections, right? So
no, I agree.
So
but it could be, I agree. And it's elections for everybody in the GST Council. Yes. So you could get a positive vote, but it's just looking that bit difficult to get that stimulus. I take your point on rural's, demand. Yesterday, the GDP advance numbers, what really came out is both in terms of constant, 2011-12 prices and in terms of current prices, agriculture growth is 3.8, which means there has been no price improvement at all for them from 2011 to now. That can be one reason why there's so much of a pain. Therefore, how will you grade up in terms of the other consumption stocks? Staples, they are the performing stocks. You say, we were talking about Page Industries, we were talking about pizza guys, we were talking about all the Maricos of the world. Is that sector still safe?
From a pure fundamental outlook, I think the consumer staples as a sector is safe. Okay, I think clearly they will kind of still grow at about close to 10-12% volume growth. And I think that's pretty robust in an environment like this. However, as investors, the challenge in consumer staples are valuations. Clearly, when you kind of going to buy stocks at 50, 60, 70p multiples, and you're willing to kind of just buy stocks at 1.5% yield to free cash flows, you're up against a wall in the short term in terms of returns to you as an investor. So clearly, while as a sector it will keep doing well, but clearly the big challenge out there is valuation. And we've seen, when growth does not happen, we've seen some of these, the poster boys of basically, some of the growth segments getting clobbered. So
Nilesh, just to follow up on that, because of, just the dramatic changes that we've seen on a stock like iShares, on a stock like Page, where valuations as a word didn't exist till just a couple of months back. And now the market is seriously derating these stocks down. So what we're seeing in terms of, let's say, a business like Page, is that limited to one company? Is it a one company issue? Or is that perhaps raising a question mark overall on discretionary consumption?
Yeah, I clearly believe that, I think what happens is that when companies grow at 25-30%, and that was the case for some of the names you referred to, these were growing at 25-30% comfortably, and therefore investors were willing to pay 50, 60, 70, 80p multiples. The 1 quarter of just 10-12% growth, and that's where it is. So the whole paradigm shift has happened from growth at any price to growth at a reasonable price. That's the paradigm shift which you are seeing with some of these individual companies, and therefore I think one has to be very, very careful when you're buying really these high PE stocks, that is there going to be growth quarter on quarter for next several quarters? Is that long runway of growth that we talk about really happening at every step of the runway or not? So that's really what needs to be kept in mind.
Now let's talk finance. You've always answered by saying that I like the retail guys, the private retail guys. Any change to private corporate or some of the... No change?
No, absolutely
they've
not.
done so well, Axis, ICICI.
Yeah, they've just caught up. But I think the bigger challenge out there is you really don't know how are things going to really yet shape up in terms of asset quality and all of that, number one. Number two, leadership change. These are finally services businesses, and in that, clearly the CEO, the leadership essentially matters quite a lot. So I think it would probably still be better to kind of see for a quarter or two how really the new leadership changes. In the meantime, you also have choice where there are banks which are giving you that fantastic quarter on quarter growth. There is strong visibility. Valuations are not totally out of whack. So I still believe that that's the space to really watch out for. Maybe a quarter or 2 quarters down the line, it's quite possible that, yes, of course, some of these corporate banks might then look attractive and you have a better sense in terms of what's really the leadership, the new leadership strategic thought process. Probably that's the time to kind of be constructive on them.
So, Nilesh, now, as a tactical play for the next couple of months, if rural India is going to be pumped with a lot of cash, whether it's a, waiver or a largesse of some sort, how do you play that? Because the two pockets through which you can play it, we've discussed auto, where you think there's anywhere genuine slowdown. If you're going to play it through FMCG, then again, the valuation argument comes back. How do you play this run-up to the elections in this market?
So What is likely to happen over the next maybe 3 to 6 months? First of all is we strongly believe that there's a case for rate cuts. Okay, and I think that's something which can happen, number one. And number two is I clearly believe that I think the street will wait for the budget or the vote on account to kind of really play out, and that's when I think the transmission of lower rates will start to happen, number one. Number two is if you're going to see some kind of a fiscal slippage, or you're going to see some kind of cash transfers happen and all of that, the loan waivers which have begun to happen, clearly I think these two will act as some kind of a demand stimulus. So it's quite possible that the December quarter will be weak, and that could create some kind of buying opportunities where stock prices could be lower. And this demand slowdown could be a bit of temporary. It could just be a pause in demand. But post the rate cuts, post the stimulus, it's quite possible that Q2, Q3, Q4 of this calendar year could be a lot better in terms of demand. And therefore, consumer discretionary is the space to be. So clearly, number one, I think, of course, is basically the home developers. That's one segment where they're below radar, and there is still some kind of caution prevailing. But I clearly believe that that is going to create, that is an opportunity. Number two, some of the consumer appliances stocks, they have been battered down, especially in 2018 has not been kind to that segment. So you clearly see there as an opportunity. Again, the December quarter could be weak for them, but that itself should be looked as an opportunity. And again, these were stocks trading between 50 to 70 P multiples. They are now down to 30 to 40 P multiples. You know, I think the band is now far more reasonable. And if they start to kind of trend lower between January to March, I think one should look at that as an opportunity. So I think these are two pockets which one can play, keeping in mind what are the macro developments which one can look forward to over the next 2-3 months.
There's one theme that is out of symphony with what you're saying, and that is the capital goods theme. Okay, if you looked at the GDP numbers as well, they're telling you that gross fixed capital formation rose at 12.2, consumption grew at 6.6. If you looked at the way in which you had the second quarter numbers, you had Larsen, Cummins, ABB, all of them telling you good order books, good revenue growth. You're not playing that theme?
I still believe the signals are still very patchy out there. It's not something which is through and through, you can really say that. See, I think what we are rejoicing is that the capacity utilization has been 70 to 73%, that's inched up to 74%, and therefore is the start of a trend. I mean, I just feel that these are just very feeble green shoots. Okay,
clutching at straws.
Yeah, I probably think the single biggest barometer or the signal that one should look for to is cement volumes. The day cement volumes get into the 10% category, that is the time you can really actually thumb the table and say, yes, the capex cycle is kick-started. So it might just be between that. You can obviously, of course, have some kind of hope that the capex cycle will revive and all of that. And one company here or there will announce some accretion to the order book and all of that. But I think if you want to really take a very universal call, saying is that yes, we are back to that 2003-2007 period when basically the economy was really firing on all cylinders, the capex cycle is there, private capex has started to pick up. I think just look out for that cement volume numbers. The day cement volume gets into 10% plus, I think that's the day to really start saying that yes, the capex cycle is reviving.
I've got a mental note. I'll call you when we get there.
What a valuable signal for all of us. I mean, it's very educating. But finally, I mean, when do you think the earnings cycle actually fires up? I mean, second quarter was not bad, but it wasn't great. Third quarter looks like, from the auto numbers, that we are not going to have yet another fiery quarter. Generally, what kind of an earnings growth are you looking at for the market? What kind of valuations at a market level, 16 times, what will you be comfortable with?
Probably, I think around that another 5 to 10% fall will really make the valuations very attractive. Okay, I think that's the way it is. I think on a trailing earnings basis, the markets are probably trading at about 21, 22 times trailing earnings. But yeah, I mean, I think sub 20, I think there would be value. There'd be a lot of pockets of value. And it's quite possible that, of course, we all have been for the last 5 years, been every year saying that, you're going to see earnings pick up. But that's really not materialized. But I genuinely believe that the next financial year, I think, should be good from an earnings outlook point of view, especially if, say, for example, PSU banks are done with the provisioning and all of that. Corporate banks are in a better shape. If crude, etc., are subdued, I think that would mean better gross margins for corporate India and therefore better profitability. So I think on the whole, I think the outlook for next year in terms of earnings, I think looks to be reasonably strong and robust.
All right. On that optimistic note, Nilesh, always a pleasure having you with us. Have a great 2019. We didn't wish you. And we hope the year sees you oftener in our studio.
Thank you. Thank you.
All right.